Hi there, Richard Little from your land partner. Today I want to talk to you about high-level numbers. So it's all part of the appraisal process. Now, high-level numbers are what we look to use in terms of ballparks when we're looking at negotiating and discussing, structuring, the deals. Now, most people actually secure deals based on high-level numbers, and we found quite a few people come unstuck on that because they take the high-level numbers, and we're going to go through those in a minute, and they effectively will do a deal, structure a deal based on that, and then when they do a full development appraisal, which, if again being honest, doesn't generally get done. It actually gets done as you go through the project, or when you're perhaps looking for funding, etc. But so we're going to be talking about full development appraisals on a number of other occasions, and go into much more detail of what we're going to talk about tonight. And the high level numbers, and for most people that watch this, it may well be as far as you get in terms of you're looking for the easy number, you're looking for that magic number, the cost per square foot, what the professional fees are, etc., what the finance is going to cost, and that's great if the numbers you put in just happen to be correct. But if you don't actually understand how to do a full development appraisal, i.e. breaking that high level number down, then you won't ever know whether the high level number was correct until you've done a few projects. So pretty much the high level numbers, as we said, is a ballpark. It gives us a bit of an idea. Now, you probably would have heard us speak before about this, but we look at ranges of numbers. We do not look at one column. Again, repeat this time and time again. How many costs can you project that will be exactly X or exactly Y? Maybe a planning application fee, maybe. That's pretty standard, but there are very few costs. So our high-level numbers start off with a range of numbers. So we're looking at all of the principal numbers in the whole process. So we're going to go through gross developed value, so GDV, build costs, developer contributions, professional fees, finance costs, developer profit. Need to obviously add a little bit of profit. And all of those will actually eventually come down for what we're looking for, which is a residual land receipt or a residual site value. So we'll just go into a little bit of detail of sort of numbers that we start off at, and they're going to be very, very wide ranging, because every project is somewhat different. So it's going to depend on the location, it's going to depend on local issues, it's going to depend on the type of project, the size of project. There's obviously the cost per square foot is going to be a lot different if you're building 2 bungalows as it is if you're building a 26 story block. The cost will obviously make sense. Well, between any build, there is going to be a difference in cost. But actually, what we're looking to do is, as I say, hit a ballpark number. So gross developed value, well, obviously that's going to vary massively depending where you are in the country, build type, etc. But what we look to do is two ways that we actually get the gross developed value. Is one, we will find out what comparables are in the area on a square footage basis. But we will also do a check on what we would for the unit type. So, say a 1-bedroom apartment, for instance, could be 30, 35, 40 square metres, or it could be 80 square metres. Be quite luxurious, probably, or certainly spacious. But if you take the point, it's not always down to the square footage, and it's not always down to it's a 1-bed flat, 2-bed flat, 3-bed house, or whatever. So you've got to look at the variables. So we do the per square foot or per square metre, and you then look at that in relation to what that type of property would be in that area. Now, that in itself in any area will give you a range of numbers, a range of values. It might be stuff right at the very beginning. You might pick off of, almost Rightmove, do some comparable asking prices. You might do a little bit more work and look at the comparable sold prices. But are you comparing new for new, or are you comparing new for previous? What, how are you doing it? So there's going to be a difference. Most people accept that there is generally a premium for new. And that premium very much varies from where you are, but typically we would sort of see premiums from new anywhere between maybe 7 and 8% up to even 20% in some cases against equivalent second-hand stock. So the GDV, we say we will look at, once we know the area, then we will actually do a few comparables, and most areas we already pretty much know what they are, so we'll have a range, and that range may be, say, for a two bedroom house, in where we are, it could be anywhere between perhaps 160,000 and perhaps touching 200 or even over 200,000. Well, that's still quite a wide range, but on our first pass to get our ballpark, that's actually what we're going to do. So if we move on from gross developed value, I'll just go back to that. Obviously, depending on what it is, there may be extra income coming from, maybe the freehold. Certainly on apartments, there's still a value to the freehold. And obviously, if it's a mixed use, then there's going to be some value to the commercial aspect of it as well. Right. So looking at build costs, so this is probably the single most numerous question that we ever get asked, and most people with experience, it's what people say: how much will it cost us to build whatever? The fact is, it could cost any amount. It very much depends on the specification, your procurement method, your buying power. There's a lot of factors here. So we still know that we're going to talk principally about new build. Obviously, conversion costs are, they can be much more wide ranging than new build costs. So we still know of developers that are building for around about £1,000 a square metre. But the fact of the matter is, most people that listen to this won't be able to achieve that. Very, very unlikely to be able to achieve that. The other end of the scale, we get lots of people say you can't build for less than 1,700, 1,800, 2,000, blah, blah, blah. Well, to be frank, if you couldn't, then a lot of developments would never get done in certain parts of the country. So our ballpark numbers generally start build costs. Now, on the ballpark number, that is generally going to include roads, external works, etc., or also utilities and things like that. So we will be somewhere, when we're not separating it out, and I'll get to when we separate it out in a minute. We're going to be somewhere probably £1,450 £1,450 a metre as a bare minimum, and that is going to be a minimum, but that's going to be an all-in build cost. So that would be with probably no demolition, nothing unusual in the ground, not too much in the way of roadway, certainly no public roadway. So that would change it significantly. So it's actually understanding what those costs are. So it's helpful, certainly for people starting out, I think, to get an understanding and split it down. So what's the build cost for the actual build itself, the shell, the finishing off, and then we separate the utility costs, we separate any road costs and external landscaping, etc., etc. So just to break those down, demolition and site clearance and all that sort of, so you'll break those down, and they've obviously all got costs, but we'll bring all those together to have that all-in cost. So I mentioned before, build costs of less than £1,000 a square metre. Well, that's actually not going to include the roads. It's not going to include the utilities, etc. So when people tell you how much or advise you, you need to know what it includes. And actually, how are they achieving that? Are they the main contractor or are they not? So in order to get to these ballpark high-level numbers, you need to understand a lot more. And that's what we're saying is, initially, you need to understand everything that goes into a full development appraisal. And that's going to come over the next effectively 3 weeks, virtually 3 weeks, when we're going to be going through every aspect of that. And we'll be talking about a lot more broken down numbers as we go through that process. So when we're looking at the high-level numbers on a given project, we'll say, right, okay, the build cost could be as low as £1,400, £1,450, including all of those extra bits, as we said, or approaching £2,000. You know, most of the places that we work in, if it gets above 2,000, then by the time you factored in all the other costs, then it's probably not going to make any money. So, so generally we're looking at a suitable cost to obviously fit what we're actually going to be building. As I say, so please, if you're not familiar with build costs, you need to be talking to quantity surveyors, QSs, but QSs that understand what the costs are in what the type of project you're doing. Just because somebody says QS doesn't mean to say they're going to know everything about actually pricing projects, what the sort you're doing. It's a bit like going to the GPs, expecting them to know all about a brain issue that you may or may not be having, or a heart issue. They've got the basics, but they won't necessarily know the detail, and it's the detail that makes the difference to you. So we see costs, we see people come up with valuations in costs, looking at cost breakdowns, etc., and they're just nonsensical. Sometimes they're too low, generally they're too high, but again, the QS is obviously covering themselves, but it's where do they get those numbers from? So when somebody tells you about a build cost, it is, well, okay, how did you get that build cost? What does it include? And because one person can build to the same spec on the same type of project at, say, £1,400 a metre, somebody else can come along and they might not be able to build it for less than 15 or 16. But that doesn't mean to say the one doing it at 14 can't do it. It could be a combination of the one paying the higher price is paying too much, or it could be they're building a slightly higher spec. Maybe they're building too high a spec for the end. But hopefully you get the point here. Is with build costs, which is one of the largest costs of a whole project, it's very easy to get that wrong. And if you get the build cost wrong by 5 or 10%, that's going to trickle down to the bottom line and on the profit, and it's going to squeeze the profit. So when you are putting numbers forward for looking for funding or investment or whatever, those numbers you put forward, you will expect to break them down at a later stage, but you've got to be able to break down. They have to actually work out. So the next thing is developer contributions. Now, in most areas, we will have a good idea of what some of the contributions might be. So contributions include one or two or no levels of community infrastructure community infrastructure levy. Very much area dependent. Yeah, so some people say, oh no, they don't pay a community infrastructure levy. Other people will pay two. So you need to understand what that is, and one of the things you need to consider with CIL is that it has to be an index number. It's not the number that's necessarily published, because it will be a number published at a certain date times an indexation for the period of time that's gone on. So if a CIL was set 6 years ago at £50 a square metre, that could quite easily be £80 by now. And that could be quite a lot. Other developer contributions, there's all sorts of things. There's Section 106, and in a lot of cases that's affordable housing. Sometimes that's a payment. Sometimes it isn't. It's on-site provision. There's numerous other things. There's 20, 30 different other things that can come under Section 106. Section 106 effectively is just the way it's collected. So you need to be aware of what contributions there may be to the type and size of project that you're actually looking to do. It's very easy to miss out on some of this. Now, if it isn't a prescribed amount and it's not calculable, i.e. if it's affordable housing, that again, you need to be talking to somebody that understands affordable housing, that understands the process, and actually can give you some guidance as to what sort of numbers you would likely to get in the area that you're at. Again, all of these things we're going to be talking about in much more detail as we go through this series of videos. Then professional fees. So professional fees vary again tremendously. So in respect of Larger projects, we would see all-in professional fees. Now, different people put different things under professional fees. So, professional fees could be a planning consultant, it could be your architect, it could be all the surveys, it could also include all the planning fees, it could include building control and warranty fees, it can include things like bonds, etc. Now, whether that goes under professional fees or it goes into build cost or somewhere different, it's not right or wrong. It's just a case of how you put it in. There are some standard-ish formats that people use, different software things, valuers use certain type, etc., or different types, but there isn't a right or wrong. But you've got to be clear on making sure you include it somewhere. So depending on what you include there, typically professional fees will have some relation to the build cost. Now, on a larger project, so for us, if we were looking at 40 homes, something like that, then our professional fees we'd be expecting to be maybe 8%, something like that. Maybe a tad lower, but rarely these days, because there are so many costs involved in surveys and reports and second level and investigations, and and it isn't, at this point, it isn't always about the cheapest. So sometimes it's sometimes you might be paying more than you could pay, but you're getting a better service. Now that can go from, as I say, 8%, maybe slightly less than that, up to, on smaller projects or more complex projects where perhaps there's it's a conservation area, there's listed buildings, there's a lot more surveys, there's a lot more paperwork to do, a lot more reports, etc. And certainly on smaller projects, we could see 14, 15, 16%. So you need to understand what is a suitable percentage for the type of projects that you're looking at. So again, at high level numbers, even ourselves that are pretty experienced in this, we might say on a project of say 40 units, something like that, depending on where it was, etc. We'd possibly say somewhere between 8 and 10%. And that's what we would have in our initial high-level numbers, yeah. And obviously, even between 8 and 10%, if it's a sort of £2 million spend or whatever, still quite a lot of money. So in our high-level spreadsheet, as it were, we've got two columns, and it's the best case, worst case to a degree, I suppose. So moving on from professional fees, we're then looking at finance. What's the finance cost? Well, to that, we need to know how much finance we're actually going to get. But we also need to know how we're structuring the funding. Are we getting sort of mainstream development funding? Are we getting some equity? Are we borrowing some equity? Is there a bit in the middle, the sort of the mezz finance, as it's often known as? So we need to have some idea, and we'll always have an idea of what money we've got available. But what we will normally do in the finance is allow the cost for everything, regardless whether it's our money, a partner's money, an investor's money, or whoever's money that is, there is a cost to it. So generally, we will know, again, depending on the project type, size, length of delivery, etc., we'll have an idea of what the finance costs are going to be. So bare finance costs for development funding can be less than 6% per annum, but even there, by the time you put all the fees in, all the monitoring and everything else, we're still closer to 8%. So generally, finance will hit us somewhere between 8 and even 20% for some people. It depends on the type of project. But as I say, when we're looking at high-level numbers for a specific project, we'll have a good idea. So using the example from before, 40 units, something like that, then we're probably going to be, at best 8% and possibly at worst maybe 12%. Because funding, we always give funding finance quite a wide range, because it gives us a lot more flexibility when we're looking at deal structures, etc. So developers' profits, so all sorts of different measures that people use on this and different understandings and things. But typically, if we want to get development finance and reasonable cost development finance, that's going to be dependent on the exit and how safe it is. So for instance, on a pretty ultra safe exit, if you like, where you've got maybe a housing association or an investment fund or whatever that are going to take the units, there's a letter of intent, etc., then it's you're likely to be able to get funding, certainly if you're putting a reasonable amount of equity in, depending on the state of the market. But generally, if you're putting down 15-20% of the required funding, down as cash, if you like, then the rest of that money is going to be available. So you minimum profit, you're either going to take profit on cost or profit on GDV. So a profit on cost, you minimum you're probably going to get away with, and this is going to be really, really gone into. So 15%. Now, most people say, no, you can't do it. But if there's a very, very decent, safe exit and the team is dead good and the numbers are actually been scrutinised and exit, then you will get away with it. Is it a real 15%? Because a lot of people that go for the 20s and the 25%, when we do our numbers, if we're working with funders or investors, they probably are going to hit 15. So it really depends what it is. So those numbers and the percentage in the high level numbers, we will generally go as a standard thing is 20% on cost, anywhere between 17.5 and 20% on GDV, something like that. So in and around those numbers, whether we go on cost or whether we go on GDV, it's a lot to do with the site value. So we'll talk about that more another day. So developers profit, yes, we hear people say they're looking for 25%, etc. You won't get any funding, but that generally will include the cost of finance, etc. We separate that out. Sometimes it does include it, sometimes it doesn't. So again, you need to be clear on the purpose of what you're doing your high level appraisal for. We are initially doing it in terms of structuring deals, having negotiations with landowners and their teams, their agents, etc. So that's why we talk about a range, and I'll come back to that in a minute. So once we've added all that up, once we start with our gross developed value, our GDV, and we take away all those numbers, then we've got what we can afford to pay for the site. Now, obviously, because we've got a range of numbers, it's going to be we can afford to pay for the site between X and Y. And it could be between $500,000 and $1.5 million. It could be that wide. Now, what we're then doing is we're looking at the differences in our ranges. So the differences, typically, the biggest differences pretty much should always be in the gross developed value and the build costs, because the rest should be reasonably easy to actually look at and to anticipate. So we then got a situation where we can start looking at deal structure and negotiation on before we start talking to people. So is there any point here that we can potentially try and buy at a lower base value and give them an overage, give them extra money at a later date once we've got planning, or if it's already got planning, once we've actually achieved some sales or some refinance, etc. And what you'll see is that the developers profit. Now, very few developers get to keep all of that profit. They will nearly always have to eat into that profit, probably for, often investors. They might give them not a percentage of the profit, or some people try to. We don't work that way, but we will give them a return based on what that potential profit is, and effectively they always get a preferred return. So the people who put the money in always get their money back first. So the development funders get their money back first, whether it's first charge, second charge, so full development finance, perhaps some mezz money, bridging the gap, etc. And then the people that have provided the equity, if you haven't done it yourself, they get their money next, should get their money next. And then lastly, us, you, the lead developers, that's when you get your money. When everybody else has had theirs, that's when you get yours. So hopefully I've not made the whole high level numbers too confusing, but the fact is there's a lot goes into it. You can't just suddenly say high level numbers, and it absolutely amazes me how many people say, yeah, that's a GTV, looked on Rightmove. Very few people admit to it, and I know some people that will watch this will have done that in the past, and hopefully they won't do it again in the future. Oh, there's some numbers, yeah. Taylor Wimpey are selling 3-bedroom houses at 300,000, right? We're going to put 6 of them in there, and that's 1.8 million. Build costs are going to be £120 a foot or whatever, but based on what, developer contributions. Hopefully there's no affordable. That's a lot easier once you've got affordable. And affordable for people that understand it is wonderful. For most people, because most people don't understand it, it's a nightmare, and they try and steer clear of it. And for the rest of us, yeah, stay away. But anyway, that's another couple of episodes, down the line. But if you don't understand those numbers, and you can't deliver on those numbers you're putting in that appraisal and those high level numbers, and you're going to start having negotiations and offering, it might be a purchase, might be a straightforward purchase, a conditional purchase, you might be offering as an option on it. But if your numbers don't work, what's going to happen? Too many people end up having the firefighting before they put a spade in the ground. It's just crazy. So what I'm trying to do is be cautious and sort of try and get people to not just do the high level numbers without understanding or getting some support, getting some support probably from the marketing side on what those numbers are, what that gross developed value is. So I'm going to finish up by going back to that, because it's probably the one where people get it wrong more than anybody else. So in a stable market, now a stable market for us is where there is a stable trend. So it could be upwards, or it could be downwards, but for us that's stable. If we can predict year on year for the last 2 or 3 years we've been on average going up 3% or whatever, we can use that. But we will only ever go on today's value, and then we will take that back, to probably 95% to see what that does. So sensitivity analysis even on your high numbers, because a 5% difference in the gross developed value, if it's going downwards, and it typically is because people overestimate it, they probably take what the agents say, and the agents are giving advice, but they tend to be quite bullish even in a downward market. So those numbers are generally still too high. But if people take that, and then people get optimistic and say, oh, well, it's going to be in a year's time or 2 years' time, so the market's going to go up, say 3% a year, so I can factor in that increase. Anybody that's heard me talk before about development, and it's true, most developers make most of their money in a rising market and out of the rising market, not because it's just right. Those that have been around a while, occasionally, let's be honest, we get one right. We get lucky, It's probably not all luck, but you can get a little bit fortunate, and you actually do manage to buy something right, and it's solid. And in a rising market, that's when you can make a great deal of money. But most people still make money out of the market. If you make money out of the market rising, you'll be the same people that lose out of the market when it's falling. Yeah. So really, just to sort of conclude the high level numbers, this is about new build, etc. There's a lot more detail that can go into this in respect of conversions and things, and we'll touch on conversions to a degree as we go through each individual aspect of it. And as I say, that's going to be over the next, best part of 20 videos, where we do deep dives into all of this and the implications. So in conclusion, high level numbers are great, but understand what they're made out of, and understand, what they actually mean, and how much you're allowing each way. So don't just have one number, have a range of numbers. And anybody that comes to me and says it's a site value of 825,000, immediately I've not got a lot of credibility. They've got to really work hard from them. If they come to me and say we've done our numbers and we think it's worth between 780 and 840, well, that's a good start. Yeah, so you should just, and you haven't got to impress me. None of you have got to impress me, but you do have to come across as credible to lenders and investors, etc. So please start talking about ranges of numbers. So in conclusion, high level numbers absolutely crucial. We often don't do the full development appraisal because until such times as we've got a little bit further down the line in terms of negotiation, etc. But we would suggest until you've done a full development appraisals or had them done, then I wouldn't try and do that. You actually need to understand, you need to learn. So this has been Richard Little talking about high level numbers in respect of appraisals, and I will catch you again on another occasion. Bye.